geopolitical risks really did dominate play on the market today. And I guess until the risks are quantifiable, we will see some of those risk players being sold off. And that's really what we saw on the market today. Usually once we can quantify the risks involved, we do see these geopolitical risks coming out of focus. But at the moment, really the market is focused in on what could happen. The focus at the moment is on Crimea, but of course it could broaden out to East Ukraine as well, and that would be a negative for markets. And of course we're also watching parallel geopolitical situations, in particular China, to see whether it does use this situation to try and make a move in terms of South or East China Sea tensions as well. And of course we're watching Syria. But altogether, one of the things that we're watching very closely is oil, and that's really because Russia has a stranglehold on energy in Europe. In fact, if we have a look at Europe, it imports about 1/3 of its oil from Russia, and Russia also has the capability to shut down the gas pipelines, which of course would cripple Europe's economy. So watching Brent crude very closely, those oil plays on the market doing very well today. Oil surge up by 2.2%, Woodside Petroleum was up by 1%, and of course the safe haven plays. Gold was a standout in Asia today, up by 1.2%. We saw stocks like Newcrest Mining up 5.7%, Bidell Resources was up 10.5%, and we also saw Northern Star gaining 7% on the market.
Gold stocks, ETFs, or energy stocks, or indeed oil ETFs?
It depends on the time frame we're talking about. Certainly in the short term, those safe haven assets are going to be very much in place, so supportive for things like gold stocks as well as oil prices, as well as safe haven currencies like the Japanese yen. But of course, longer term, the fundamentals of the market haven't changed. And if we have a look at earnings season, one of the positives to come out of earnings is that we actually saw an upgrade to consensus. Now, it was a small upgrade. Previously, the market was forecasting 14% growth. Now we're facing 14.7% growth. Excluding out resources, which is expected to be a large chunk of the growth this financial year, it's gone from 8% to 8.7%. Now, the thing that's positive about this is not so much the move, but the fact that earnings tends to move in cycles as well. So once we start an upgrade cycle, it does tend to be a multi-year cycle. So I guess the outlook for the market looking much better than it has on the earnings front and the valuation front than we've seen in the last 3 years. And I think that's going to be a positive. In terms of the geopolitical risks and what we're seeing in Ukraine at the moment, once we can quantify the risks, I think it's going to take a backseat to what's happening in terms of actual companies in the market.
Do you see anything else globally, domestically coming up that is likely to give direction to the markets?
This week's going to be absolutely huge. I mean, here domestically, just in Australia, tomorrow we'll see the interest rate decision. Now, the markets are expecting to see the interest rates remaining on hold in Australia for some time, but we will be watching the statement closely. And then that's followed on Wednesday by the fourth quarter GDP numbers, and then Thursday by retail sales and the trade balance numbers as well. And of course, globally, it's a massive week as well. It's manufacturing week, so PMI week. We've already seen the read out of China and manufacturing at an 8.5-month low, but that was probably distorted by that Lunar New Year holiday. And then, of course, we also see central bank decisions. The big one to watch being the European Central Bank, with inflation quite low again there, so the possibility of a rate fall, followed by the biggest economic release globally, and that's non-farm payrolls out on Friday in the US, where 150,000 jobs are expected to have been created in the month of February.